What's up, guys? It's your boy, Quick Stocks. As always, remember to hit those thumbs to recharge my dopamine, and we will get right into your quick stock analysis of Zoom, ticker symbol ZM, trading for $370 a share as of September 5th, 2020, equating to a market cap up $104 billion and a pretty crazy PE of 472. What a time to be invested in Zoom, as the company has seen a 20% correction in share price just in the last few days, but certainly still buzzing from their record earnings, as even after their aforementioned share correction, Zoom is still up 20% in the last 5-day period, and nearly 300% in the last year. So what's the move? Are we joining the Zoom meeting or muting our mic? This is your quick stock analysis. Of course, Zoom's portfolio of products include its HD video, voice, and chat service, Zoom Meeting, which you are all probably the most familiar with. But you also have Zoom Phone, an enterprise cloud phone system that provides secure call routing, call queuing, and call detail reports. Zoom Rooms, a software-based conference room system, and Zoom Video Webinars, which enables users to conduct large-scale online events, such as town hall meetings, workshops, and marketing presentations. As you may or may not already be aware, Zoom absolutely smashed their Q2 earnings. Highlights include a 355% increase in quarterly revenue, and they predicted a stunning 284% increase in sales for the full fiscal year. Investors initially hailed the news, sending Zoom stock up more than 40% after hours. However, pump the brakes. Some of the hype has blown over as the company sold off late last week. Although, take into consideration, this has a lot to do with the tech dump, along with an overall market sell-off. Let's take a look into Zoom's balance sheet to see if this sell-off was warranted or if investors have become too pessimistic. As of January 31st, 2020, Zoom had $283 million in cash and $572 million in marketable securities, which we will call a total of $850 million. As you can see here, the company reported in their Q2 earnings they now have $749 million in cash and $733 million in marketable securities, totaling just shy of $1.5 billion in cash, marking one of the best performing software companies, at least on a 6-month time frame, which an investor should note includes the start of the global quarantine. Anyways, moving down, even more astonishingly, they doubled their total assets from $1.29 billion to $2.62 billion. And in regards to the company's liabilities, the company currently has $1.4 billion in total liabilities, which is easily covered in Zoom's fat cash stack. All of this makes for one really impressive balance sheet, and as a bonus, Zoom is experiencing insane growth on the top and bottom line. It really is no wonder why many investors are hopping on the Zoom bandwagon. Anyways, now that we've hyped the company, let's take us back to reality. An investor has to ask oneself, does this warrant a $104 billion market cap? This is still pricing in absolutely insane growth for the company. Remember, people are buying Zoom because it's a growth company. However, an investor has to ask oneself, a year from now, is Zoom going to be able to 2x or even simply match its current $663 million top-line revenue? A lot of bears argue that the quarantine restrictions accelerated the growth to an unsustainable level. In our research, we've seen a lot of people ask, why would an investor pay such a steep premium for a company who clearly won't be able to maintain this level of growth, as they've already tapped most of their pipelines, not even considering some of their competitors gaining traction within the market. However, I can see both sides. Certainly, this level of growth isn't sustainable, and the company is trading for a hefty premium. Although, regarding optimistic investors, the genie is out of the bottle and it's not going back in. As the world regains a sense of normalcy, we are starting to realize our normal way of life is going to be even more digitally oriented. Along with this, employers are realizing even if employees can come back to the office, in many instances it's beneficial to have people working remotely. Like we covered in our Facebook analysis, the company states they are going to continue to recruit remote workers even after quarantine restrictions are lifted. Simply put, it gives them access to a larger talent pool, and it's an added bonus not having to deal with the hidden costs associated with having these massive physical locations. Along with this, sure, many of these large institutions may not use Zoom services as much once the world regains a sense of normalcy, but that doesn't mean they won't continue to pay for the membership. I can see many schools continuing the service as online curriculums have already been developed. Side note, sorry kids, you may never have a proper snow day again. Another example is doctors' offices. A lot of people have found the convenience of using teledoctors. Shout out to your Quickstock company choices, OnTrack and Teledoc. Of course, this also helps corporations' bottom lines as they don't need to pay for travel-related expenses when they can just have their employees meet remotely. And for time's sake, this really just scratches the surface. And final thoughts before we get into what's our move. Let this sink in. Taking us back to Zoom's recent earnings, net income was a whopping $186 million, which is absolutely bonkers. Take into consideration a year ago, had someone told you that Zoom would be racking in $186 million in a single quarter, it would have been a fantasy. But this is no longer a fallacy, and if you're looking to start a position, you have to be aware this is priced into the company's current share price. However, one could certainly argue Zoom will continue to use their great brand name to develop new products. Finally, quick side note for hype investors, Zoom has a virtual experience meeting October 14th through the 15th. As always, link in the description if you would like to sign up for free. So with all of this in mind, what's our move? Well, the 20% correction in share price in the last few days certainly does make the company more attractive from an investing standpoint. But take into consideration, Zoom is still up 20% in the last 5 days, and nearly 300% in the last year. And as an investor, I wouldn't consider this correction to be a flash sale or bargain pricing by any means. Take into consideration, at its current levels, you have to invest $472 of cash for every single dollar the company currently takes in. And remember, there are other massive tech companies including Google, Facebook, Microsoft, and a ton of smaller players who are gaining traction within the market. And to be transparent, Zoom is still overpriced. I'm not saying the company isn't going to continue the run-up. In all honesty, I wouldn't be surprised to see it recover back to its all-time highs within a few weeks. But shameless plug, if y'all want to check out other companies in the communication technology market, check out our Teledoc and OnTrack analyses, which I would argue offer much more potential upside when compared to Zoom at its current valuation. With all of this in mind, in regards to our Quickstock's long-term portfolio, we are going to continue to watch Zoom from the sidelines. It's been a crazy story for the company. It really is a testament of being at the right place at the right time. The real question is, can Zoom continue this market dominance? Well, simply put, we're gonna have to wait and see. I'd love to hear y'all's opinions. However, take into consideration, we are certainly not a financial advisor. Please do not buy anything just because it was purchased here on Quickstocks. Anyways, guys, that's all we've got for today. As always, the best investment you can make is to go long on Quickstocks. Hit that subscribe button now at 1,550 subscribers and plan an early retirement. I will catch you guys in the next one.